Okay, welcome back. The markets picked up from the day's low, at least the first hour low, and that is good news as we've been pointing out. Well, China reopening is the big theme, right? I mean, especially from an Indian perspective, because all of last year we've heard how China is kind of out of the game because of these rolling lockdowns that they've been facing, and how that is an advantage for major economies like India. But does the China reopening introduce major competition for both economic growth and flows as well from a market point of view? To discuss this, we have two very special guests joining us. Mattie Bekink is China Director at the Economist Intelligence Corporate Network. Mattie, great to have you with us here. Thank you very much. Xinxin Li is Managing Director at the Observatory Group. Mr. Li, good to have you with us here on the program. I believe you're staying up late for this. Thank you so much for doing that. Appreciate it. Mattie, let's just start with what's happening on the ground in China in your in your perspective. Is this a hard, very sudden, dramatic reopening here to stay? And how would you rate it in terms of how dramatic and how aggressive this is as compared to what you expected?
With you, and it has been more dramatic and more unexpected than anyone could have forecast or imagined. Here on the ground, sometimes people describe it as a V turn rather than a U turn because it was so absolutely sudden. I think it's important to remember that just a few short weeks or even the week prior to the transition and kind of the abandonment of zero COVID restrictions, the state media was still speaking about the controls of the virus as the all-out people's war against the COVID virus, and that there was a real emphasis on sticking the course even after the 20th Party Congress and into November. And so the sudden shift was quite unanticipated. And we've gone in China from having some of the strictest restrictions anywhere in the world related to COVID to having basically nothing in a matter of weeks. It's also a COVID naive population because we haven't had anything akin to a major outbreak that was across the entire nation until now. So it's been a challenging time. I think to your comment opening this conversation, though, the zero COVID policy in China has really had a chokehold on China's economy in 2022. It worked very effectively for the first 2 years, but since the Omicron transition, the need for increasingly restrictive controls and lockdowns has stomped on consumer and investor confidence. And that's why this reopening is so important in terms of economic news and recovery as we head into the new year, or we are in the new year, excuse me.
Absolutely. Mr. Li, what about you? What are your thoughts on the reopening in China? I'm sure the transition must be challenging as well, right? From this zero COVID policy straight to a complete reopening. What do you see as the way forward now? And what are you penciling in terms of growth projections?
Well, I think China's reopening is one of the most dramatic shifts in the past few years in this global pandemic. China is the first country gets into the COVID, and now is the last country getting out. But the way China is exiting from the pandemic is quite dramatic. And over the past few weeks, there have been a dramatic shift by Chinese policymakers on several fronts. Not only zero COVID policy, but also the regulation on the private sector, including the housing market, and even China's foreign policy. I think this is a combination of the policy shift after Xi's third term started in China. And more importantly, there is a very strong policy intention, which is pro-growth and pro-business at this moment. The backdrop of this policy shift is that there is a rising public anger. There's a very negative public opinion against the zero COVID policy. There's also a very dramatic cost of zero COVID policy, this lockdown and the economy. It's estimated that over the past 3 years, the zero COVID policy has cost China at least 2 percentage points of GDP growth per year. And also there's a changing external environment. In the past 3 years, China's export growth was doing relatively well, which contribute about 1.3 to 1.4% of GDP growth over the past 3 years. But in the second half of last year, China's export growth was cooling down very fast. And in July, the export growth was 18% year on year. positive. But in November, that number was negative 8% growth year on year, suggesting that the external demand for Chinese goods was cooling down very rapidly. Against this backdrop, this zero COVID policy probably is unsustainable. I think that's the most important reason behind this dramatic shift of zero COVID policy. Looking forward, we believe there is there's a headwind. There is also the tailwind, and also an uncertainty in the economic process. The growth projection for 2023. The economic, the tailwind is clearly from this reopening. I think in the current stage, the reopening is the best economic stimulus to Chinese economy. It's better than any other policy stimulus, including monetary easing and the fiscal stimulus. It will unleash this pent-up demand from the Chinese households for the consumption, and also especially we are already in this Chinese New Year time. The travel levels during the Chinese New Year is a very important indicator to measure this pent-up demand and is recovery. And another thing is that we are going to have this negative contribution of the export growth to GDP this year. So this is a clear headwind for Chinese economy. And the third point is this deregulation trend in China over a quite wide range of private sectors, including housing sector, including the private tutoring companies, and also the internet-based service companies, including Alibaba, Tencent, Didi, you name it. So I think if we put this together, there is a chance that China can achieve the growth target set by this government at 5%. But there's a lot of uncertainties down the road. For example,
no, that's very Mr. Lee, just coming back to you, but very well put. I mean, all of it together, Mattie. So as you said, this is not a U-turn. This is a V-turn, as many of you said were describing it. But this is not just about the COVID zero COVID policy, right? As Mr. Lee mentioned, it's about excessive regulation, going after internet platform companies, very aggressive foreign policy stance. Are we going to see a bit of a U-turn or V-turn on all those aspects as well? Because I would assume it was the cumulative effect of all of it which put off foreign investors in a very big way. Your sense?
I think that's correct. 2023 will be a year of change and challenge for China for some of the reasons that you've mentioned. We're also seeing a third Xi administration, and I think the big question will be whether this new administration will undertake the economic reforms and structural reforms necessary to ensure China's long-term competitiveness, or some of the lingering and pressing short-term issues like the property sector, like the transition out of zero COVID, which yes has stoked optimism, but will certainly be a bumpy road moving forward. Will that kind of distract from that agenda? But with the third term secured, you're already seeing certainly that the new administration or the incoming administration is focused on shaping the economy and the society that China wants for the future. It's very clear that growth and development is a top priority, but balanced with concerns about national security and social fairness. So I do expect that we'll see further policy shifts that are aligned with that longer-term vision for China.
So, Mattie, is it fair to assume that large foreign investors could be hesitant to put big chunks of money into a market like China purely because of the flip-flop in terms of policy that we've seen, at least over the past 2 years?
So one thing that we saw in 2022 was that a lot of foreign investors, and this includes MNC and other kinds of investors, hit the pause button on investment plans in China because of the uncertainty in the market related to zero COVID, some of the other kind of more broad issues around geopolitical tensions, supply chain concerns, the longer term conversation around decoupling. So one thing we are forecasting within the Economist Intelligence Unit is that we'll see a softening of the FDI differential between China and kind of ASEAN or Southeast Asian nations in the coming 5-year period. As you alluded to in the kind of the opening comments, this is also somewhere where there's a question of whether India might stand to benefit from this, of course. However, the Chinese market is simply too attractive and kind of too central in the global economy and in global supply chains for investors to kind of back away from entirely. recovery. And I think this kind of final signal, despite the kind of uncertainty and the bumpiness that we're experiencing now with pressures on the healthcare system and surging infections, et cetera, that will at some point even out. And I do expect that we'll see kind of a renewed interest or kind of a resumption of interest in the China market.
All right. Lady and gentlemen, we will leave it at that. Thanks a lot for stopping by, and thank you for waiting so late, Mr. Lee, for us. Thanks for speaking to CNBC TV 18. Well, that's what you can expect from China. For the market, by the way, we have seen a bit of a recovery, so that's good for the bulls. The Nifty is back above 17,960. It's been a tight range for the market between 17,900 and 18,200, so we are within that range. But at least today, after yesterday's deep sell-off, there is a tad bit of recovery that you're seeing on the market. From Prashant, Nigel, myself and the entire team, thanks a lot for watching Bazaar. Lots of trading ideas lined up on Chartbusters next.